Trader Bear back, and today we're going to be talking about candlestick patterns. Candlestick patterns are some of the most powerful trading concepts known to man. They come simple, are easy to identify, and are also proven to indeed be very profitable trading setups. Research has confirmed that candlestick patterns have a very high predictive value and can produce a very positive result when used correctly. There are many different types of candlestick patterns, some used to identify potential reversals in the markets, while others may be used for reasons such as market continuations and identifying indecision in slow-moving markets. We're going to be giving you the top 5 most commonly used candlestick patterns used by both beginners and expert level traders in the hopes that you study them and begin to use them to increase your probability and consistency in the market. Starting with the hammer. The hammer is one of the bullish reversal patterns. This candle forms when sellers push the markets lower after the open but get rejected by buyers, so markets close higher than the lowest price. The long wick at the bottom of a hammer indicates that sellers attempted to continue to push the price down but were unsuccessful as the buyers came in and shot the price all the way back up, closing higher than where the markets originally opened, thus forming a candle that looks very similar to an actual hammer. Once this hammer forms and the candle closes, this could be an indication that you might want to get in at the opening of the next candle, depending on your confirmations and what it is that you look for in the markets. Hammers will typically be found at the bottom of the market, bouncing back up right around your support levels. Next up, we have the bullish engulfing candle. The bullish engulfing candle is one of my favorite candle reversals. When the bullish engulfing candle forms at the end of a downtrend, the reversal is much more powerful as it represents a strong change in direction at the bottom of the market. The engulfing candle is formed when the current candle completely engulfs the previous candle. To be considered an engulfing candle, at least one candle to the left must be completely consumed by the current candle to the right. This signifies a huge win and takeover of buyers in the market. On the opposite side, we have the bearish engulfing candle. This pattern forms at the end of an uptrend, and this indicates that buyers are completely engulfed by sellers, thus indicating the clear reversal from uptrend to now downtrend. Once the bearish engulfing candle forms at the top of the market, bouncing off of resistance and completely engulfing the previous candle to the left, at the close of the bearish engulfing, you should begin to get ready to start looking for sells in the market. Another popular indication of market reversal to the downside is going to be the bearish shooting star. This formation is also a pattern that indicates the end of an uptrend and will start to signify the beginning of a new downtrend. The long wick at the top of the shooting star shows us that as buyers continued to push the markets up, they could not maintain that strength. And before candle close, sellers came in to take over and push the price all the way back down, closing that candle below the previous candle open. When you think of the shooting star, think of an actual shooting star in the sky. You're going to see the star itself with the trail that follows behind it. This is why this reversal is called the shooting star. The markets were pushing up, sellers came in to take over, and immediately shot the price right back down. Last but not least, we have the Doji. The Doji is one of the most important Japanese candlestick patterns, and when this candle is formed, it shows us that the market has opened and closed just around the same price, which means that there is actual equality and indecision between both buyers and sellers. There is no one in control, and unlike the previous 4 candlestick patterns that we just went over, the Doji is one of the patterns that doesn't signify a reversal, but could be used for identifying either a continuation of a trend or just indecision in the markets, causing a bit of confusion. Though the Dojis indicate no real signal of where the markets might go next, you might find some reversal patterns following a Doji, which will then give you the signal of where the markets might be moving. So for example, if the markets are pushing down and we spot a Doji, it might signify to us that buyers are attempting to take control. Now, depending on what happens next, whether we get a continuation of sellers continuing to push the markets down, or maybe a candlestick or two later, we get a reversal candle, such as the hammer, that will indicate to us that buyers are now taking control. Dojis are best used when paired up with reversal candles to let you know that there was some indecision, and then once that reversal candle is formed, you can now tell that the indecision is over, and now it's time for a reversal. You should practice using these candlestick patterns by going back to previous markets and attempting to just identify and spot them for yourself. As you get better at understanding the tops and the bottoms of the markets, or support and resistance, you're going to notice these patterns more frequently, and eventually it'll almost become second nature to identify them. Just as any other confirmations or indications of where the markets might move next, candlestick patterns might be very profitable on their own, but they are best paired up when used with other techniques such as market structure or simple indicator-based confirmations that you might use in your strategy. So hopefully this made sense to you, and if it did, make sure you give this video a thumbs up, subscribe if you are not already subscribed, because here at Trader Bear, we are here to help. I'll see you in the next video.